welcome. I am Piers Ridyard, CEO of the decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi into the mainstream. This is our podcast, the DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I'm joined by Tascha, co-founder of Alpha Finance. Alpha Finance Labs is a DeFi incubator focused on bringing cross-chain DeFi products that look to bring alpha to users across a variety of different blockchains, including BSC and Ethereum. Total value locked in Alpha Homora, the first product, currently stands at assets over $1.1 billion. Tascha, thank you so much for coming on the show.
Yeah, very glad to be here. Thank you, Piers.
So, you guys are an incubator lab, right? Like you look at building products in the DeFi space, and you talk about this idea of like looking for alpha. So for those people who are maybe not so sort of like financially minded, what does that mean? What does alpha mean in finance?
Mm-hmm. Yeah, so it's the gain that you can get in addition to, the typical market gain, right? Perhaps if you just to invest in a particular stock, the gains is so much more than if you were to invest in, for instance, an overall index, right? So that additional gain is pretty much considered the alpha. So correct, we're looking for those alpha through, a lot of fine tuning on product market fit. So the alpha here comes to not only the investors, but also to the product users as well.
Interesting. So like alpha is like the outsized returns. You're saying there's the outsized returns over the market, the standard market return. So how do you guys define alpha in DeFi?
Yeah, so I think there are two ways that you can look at it, right? Definitely from the product side of things, it's more on, what's the missing piece that we can build and will really provide so much value for DeFi users. And not only for DeFi users, but for other protocols as well, right? So pretty much provide more value to the whole DeFi ecosystem. So that's from the product side of things. And definitely from the token investor side of things, once the product has a lot of product market fit, then it translates to more users using it, more protocol fees capturing, more valuation, just the foundation is strong. And it just comes as a positive feedback loop and bring more alpha to the token investors as well.
Sure, but I mean, like actually, practically, how do you define alpha in DeFi? So let's say, like, do you take the standard return on USDC as your beta on Compound and Aave? It's like, okay, I get like a 10% return just putting USDC on Compound or just putting it on Aave, and then if you guys then return more than that 10%, you guys are defining that as the alpha in DeFi, or are you, or like if you're saying that you're delivering alpha, there has to be a benchmark, right? So how do you guys benchmark what the market is versus what you guys deliver on top of that?
Mm-hmm. Yeah, so this really depends on what kind of products we're talking about, right? Let's say if it's a lending product, which Alpha Homora is also a lending product in addition to a leverage yield farming, right? So as a lending product, Alpha Homora V2, particularly if you compare the lending assets that you can lend on Alpha Homora V2, the rates on Alpha Homora V2 are generally, a lot higher across the boards, across all assets that we support, comparing to other lending protocol in the space, right? And these asset lists are not just, ETH, BTC, and stablecoins, right? These are like DeFi governance tokens as well, where you don't have that many places to lend. So this is, a one-stop shop for the lenders. And then for you farmers, those are also comparing and benchmarking with typical yield farming processes. And of course, the yields and the alpha will be more from doing leverage yield farming through Alpha Homora V2.
Got it. So from the point of view of the to the user, to the investor, to the capital provider, your pitch is we will always deliver outsized returns for any given product category that we decide to deliver a product in. Mm-hmm. Is that accurate?
Yeah, I think that's an accurate description.
Okay, so let's start with the first product, Alpha Homora. What did you guys identify as the opportunity? Like, how did you first come up with the idea of building Alpha Homora? And then, like, talk me through a little bit that iteration process you've gone through, because I think you're on 2 chains, plus you're now on your second version of the protocol as well. So that'd be great to hear both of those stories.
Sure. Yeah. So back in end of 2020, right, we saw there were 2 huge market gaps, 2 separate ones, and pretty much we find a way to combine them and create a new category called leveraging farming. The first market gap that we saw is that there are so many ETH holders in DeFi, and pretty much there are not that many high yielding opportunities for these ETH holders, which is a pretty large community, right? And of course, everyone would definitely want a good APY, a good lending APY on ETH. So that's already a huge gap, and if we can find an innovative solution to that, then that alone is a huge market. A second one is also youth farmings, and youth farmers themselves have been yearning and searching for more yields. Typically back then the yields have been coming down for quite some time, so pretty much they're still finding for ways to do more yields, and they're exploring more advanced strategies. And of course not everyone will be able to perform those advanced strategies by themselves, right? So we combined the two, and pretty much we created the first Alpha Homora version. So that was on Ethereum as well. That was V1. And when we created it, it was pretty much the place where ETH lenders can lend and earn like 8 to 10, right, % of lending APY. That's the average.
Which by comparison, for people who are not aware, is amazing, because on like Aave or on Compound, you're getting less than 1% on ETH. And that's I think that's partly just because supply and demand, right? Like ETH is the dominant asset category on Ethereum by quite a margin, and there's not so many places to actually use the ETH to generate alpha via separate strategies that you might want to borrow against it, which is, I suppose, the question that I would ask next is, where does that 8 to 10% come from? Like, why are you guys able to offer 8 to 10% when like Aave isn't?
Yeah, so that is coming from the second part of the market gap, right? That we saw that, hey, there's so many there's so many youth farmers who are willing to take more risks and also get more APY out of it, right? They know they want to manage more advanced strategies in exchange for the higher APY. So once we map the two with the lending of ETH, we actually allow youth farmers to come to Alpha Homora and lever up on their yield farming position by borrowing these ETH in our lending pool. And pretty much a lot of the yield farming pools on Uniswap, SushiSwap, these are like ETH based already. So if you want to lever up on, let's say, ETH USDT pool, then you can use Alpha Homora, which the product itself would borrow the ETH token on behalf of the leveraged yield farmers, and then pretty much supply more of the capital for yield farmers. So which means that, if yield farmer were to yield farm, typically they would get the rewards as if they were to yield farm with their principal amount only. But in this case, they're yield farming from the capital of the borrowed amount plus the principal. So hence the rewards will be, higher as well as the risk.
Okay, so let's break that apart a little, because I know that there's like the DeFi is such a deep field of like of financial terms and like very specific strategies that often, like, we go, oh, yield farming, and it can mean lots of different things, right? So could you give a specific example of how of what a leveraged yield farming strategy would actually look like? Just sort of like a step by step, where the assets are going, how they're being used, what's coming back, what's being done with what comes back, and like why I as a yield farmer would choose a leveraged product, and then like what the risk characteristics of that are.
Yeah, so to answer that, let me quickly go through a typical yield farming on an AMM product, right? AMM as in automated market maker, like Uniswap, SushiSwap, which have liquidity pools and also have incentives for those who provide liquidity to these liquidity pools, right? So typically, for instance, for SushiSwap, a typical yield farming process would be that you supply, for instance, ETH and USDT to the ETH USDT pool on SushiSwap, and then get the LP token to stake on another place on SushiSwap. And then by staking that LP token, you're getting the Sushi governance tokens as rewards.
Right.
So all of those, right, is something that Alpha Homora helps automate, plus allow you to lever up even more. So what that means by using Alpha Homora is you would come to the product, Alpha Homora, you would select ETH USDT pool. And then after that, you would select, how much capital you want to put in originally, and then decide, hey, what's the leverage that you want to enter at? Maybe it's at 2x because you want to, only borrow a certain amount of ETH, maybe not too much. And then from there, what happens under the hood is, for instance, if you supply 10 ETH in total, right? And then you click 2x. So that means that Alpha Homora product will borrow another 10 ETH for you from the lending pool. And this is all V1 because it's a lot simpler than V2. So now your position. Yeah.
I'm glad we're starting simple.
Yeah. V2 is a lot more complicated. But yeah, so now you have 10 ETH starting and then 10 ETH borrow because you're doing 2x, right? So you're actually, your capital now is 20 ETH, even though you actually have 10 to begin with. And then from there, Alpha Homora would take this total of 20 ETH to provide liquidity to SushiSwap ETH USDT pool. And then because of the higher amount of funds that you put into SushiSwap, you would get more of the Sushi tokens back by being your farmer on their platform.
So in this instance, I suppose for me to go into the ETH USDT pool, according to how AMMs work, I have to have 50% of each of the assets, right? So if I start off at 10 ETH and I leverage up 2 times, my exposure is actually going to be 50% ETH and 50% USDT.
Yeah, correct.
So where's the USDT coming from? Are you just selling ETH into the pool until you have enough USDT on the other side?
Mm-hmm.
Or are you getting the USD in from another place?
Yeah, so we do have optimal swapping, which means that the product would calculate how much your position would have to be swapped into another token. So let's say if you start with 10 ETH and you do 2x, then that means about 10 ETH would have to be swapped into USDT. So that is actually not an ideal scenario because then that means you have to go through a slippage and also the swap fee. So typically how users use Alpha Homora would be for them to supply both sides. Or let's say if they want to supply USDT only, they can as well. And then they do 2x by borrowing ETH alone. So that means, after the borrow, they would have the same amount of ETH and USDT without any swapping.
Okay. And then so the risk here, if I'm sort of understanding it correctly, is because if you don't provide both sides, your risk is then based on the fluctuations in the value of the the other asset, of the asset versus the other asset. So if Ethereum rose significantly and you've sold 50% of it, you're going to end up in a situation where you would essentially not have enough collateral to cover your position.
Mm-hmm. Yeah. So this would be similar to, you can think of your position as being a borrower of these ETH tokens, right? So by leveraging farming and you're borrowing a certain number of ETH, if ETH price goes up, then that means that the value of your borrow also increases. So that means you've got to make sure your collateral is in a safe place enough to have the position continue to be active.
Got it. And then the Sushi tokens that come back, right? So for context, SushiSwap provides incentives for people to provide liquidity, because liquidity for SushiSwap means that more trading occurs, and more trading means more fees, and it's sort of like a virtuous cycle for the platform. So they give out their governance tokens to people who are providing liquidity to pools that they are saying, hey, we would like to be the most liquid pool in DeFi for these particular ones, right? So you get the Sushi tokens back, which also have their own traded value. Does Alpha Homora then also sell those Sushi tokens and return you back the asset that you're borrowing in, or does it do something else?
Yeah, so for V1, the product would allow users to help reinvest So it's pretty much like in V1, in simple terms, these farmed tokens or the rewards tokens will be sold into the user's position, which means that they're accruing compoundedly from these rewards. But in V2, we actually changed that and not, frequently selling these farm tokens, just so that we don't hurt the other projects as much, right? And pretty much we allow the users to claim and then decide what they want to do with it.
Is it what was the difference in, so obviously like if you're automatically selling in V1, what did you see the typical user behavior in V2 change to? Was it the majority still claimed and sold periodically, or did you see a complete shift in behavior and actually only a small percentage of them regularly claimed and everyone else just kept the underlying tokens that had been farmed?
Yeah, typically people wait for quite some time to claim because it actually takes, the gas fee and everything to claim these tokens too. But yeah, we don't know what they do after they claim. Maybe they sell it, maybe they, stake it or just hold it.
Interesting. Okay. So you guys built Alpha Homora V1. What did you learn in the process, and what changes have you guys subsequently applied in Alpha V2?
Mm-hmm. Yeah, so I think definitely a lot of usages were flowing into Alpha Homora V1, right? And we want to make sure that it continues to expand to more types of user groups, and not just the ones that, let's say, want to borrow ETH to lever up on their yield farming positions, right? Because there are also a lot of people as well who are in the position that, hey, I don't actually want to borrow ETH because they believe that the price will continue to go up, and hence they won't be, that would be good for their position, right, as their debt continues to rise. So we want to keep it a lot more flexible, and also expand it to the pools that are not only ETH based. So hence the stablecoin based pools, right? So these are definitely a lot less risky pools, because all the stablecoins should be pegged, right? So the risk here isn't more on, that you're afraid of the token price will go up and hence your debt will rise, but it's more on making sure that the stablecoins that we add are pegged. So I think there are like different pros and cons with it. But from V1, we learned that, we want to make it more flexible, more types of pools, more types of AMMs that we work with. So hence we created V2, Alpha Homora V2. So with V2, you can see that there are a lot of options and flexibility for all types of users, right? So if you're lenders, you can not only lend ETH, which is the only option in V1, right? But here you can lend like more than 10 assets on Alpha Homora V2, which, all of these assets are generating pretty high yields. And if you compare to other lending protocols, it's a lot higher on Alpha Homora V2. So, that's for lenders. For you farmers, you also have a lot more options in terms of the pool types. You can go to the Curve 3 pool and lever up on the stablecoin pools. For a particular pool itself, you also have more options, right? You can also supply the LP token. So for instance, if you already provide liquidity in the ETH USDT pool on SushiSwap, and you don't want to take the underlying assets out and then supply it again on Alpha Homora. So you can actually take that LP token and put it in Alpha Homora, and then we can lever up for you. So pretty much, a lot more flexible on the yield farming side as well. So yeah, I think that's the learning that we got.
And from the point of view of a user, right, who's sort of like relatively unsophisticated, they'll land Alpha Homora V2 and they'll be like, okay, cool, I can get 20% on USDC, or I can get 30% on USDC, depending on how much leverage I put on. Like, how can you describe in like a simple way how someone should think about the risks involved in leverage, and like how they should make their own personal judgment on, how much they should add into, juice the return, so to speak, using a stable coin. So like forgetting the volatility risk of Ethereum for a second, just using a stable coin. How do you think about that what do you advise, or what do you suggest someone who's thinking about using these products for the first time, how they think about their own personal risk?
Yeah. So, first there are two options, right? If you want to just simply lend your stablecoin, that's the safest way, and you don't have to worry about leverage. You don't have to worry about stablecoins depegging or anything. The experience is the same as lending assets on any lending protocol, and pretty much these lent assets are being borrowed by youth farmers. So if you want to do more advanced strategies and hence higher APY, you would go for the leverage youth farming side. If not, you go to the lending side, which is the earn tab on V2. So now, let's say that you want to go for the youth farming side, right? Definitely, as you mentioned, that the stablecoin pools are a lot safer. And the most popular pool is Curve 3 pool, which is on Alpha Homora V2 as well. So in that pool itself, it's USDT, USDC, and DAI. So pretty much, depending on what stablecoins you have, and how much you want to supply, you can decide on those. In terms of the particular leverage itself, we actually have a new feature which we launched a few weeks ago, which is the default basic farming mode, which means that once you select how many assets you want to supply originally, and then once you select the leverage number, then it would optimally show you the assets and also the amount that you should borrow to ensure that you go through the minimum or the minimal slippage as much as possible. So pretty much you don't have to think through, which asset you have to borrow at what amount, because the product thinks all of that for you. The only thing you just have to think and input are, number one, what assets you have and how much you want to put in as a starting capital. And then second is what's the leverage. And in terms of the leverage itself, we also have a lot of the guidance on the UX UI as well to give you some pointers that, hey, you should not go that far because then you're going to have quite a little buffer before liquidation. So this is the good range that you should be in, something like that. So once you select the two, then everything else is generated for you already.
So what could cause a liquidation in the Curve 3 pool? USDT, USDC, DAI are all stable coins. And so if I leverage up to the max, what would be a scenario where I could end up getting liquidated?
So first thing that would need to happen is you actually open at a max leverage. Even though you open at a max leverage, there is still a buffer, a pretty huge buffer before liquidation.
Sure.
But even then, what could happen is, let's say one of the stablecoin loses its peg, and pretty much the Oracle prices that we get from, which is from Chainlink and Band Protocol, feed the prices that are off the peg, right? Then that's also going to be the case where the borrowed funds, which are in those stablecoins that are off the peg, are causing the debt to rise higher.
So what's the maximum leverage you guys offer, and how far off the peg would something have to move for it to cause 100% liquidation event?
Yep. So at the moment, the max is around 9x on the Curve 3 pool, right? Each pool is different because Curve 3 pool is all stablecoin pools, so it can go up to 9x.
Yep.
And then from there are two sets of buffer. The first buffer is around 10% of stablecoin movement. So if one of the stablecoin that you borrow, spikes up 10%, then that would trigger a liquidation point. And then once liquidation point is hit, you are not underwater yet, which means that your funds and your collateral are actually more than the debt. And we have another buffer, which is another 10% of stablecoin, price swing. So if let's say, stablecoin swing 20% at a time, then that can be a point where you can be underwater.
Okay, so a 20% swing in the value of any of the stablecoins in the Curve 3 pool.
Yeah, which is a lot for a stablecoin.
It's a lot. Yeah. I mean, looking historically at USDC, USD. I mean, it does have USDT in there, so. But assuming that that's all fine, then that the USDT, USDC and DAI have all like their variance off $1, even in like very high volatility periods, has been, less than 2% most of the time. Because there's just so many arbitrageurs who are happy to come in and take that profit between the highly traded liquidity on exchanges versus, or any other decentralized exchange as well. Okay, and for my 9x leverage, what are the what's the kind of returns that I can expect for that?
Yeah, so at the moment now, if you look on Alpha Homora V2, right, and if you check the curve 3 pools, I'm pulling it up right now. The APY should be around 34% for this stablecoin pool. So this is not 9x. This is showing the optimal APY,
right?
Because 9x may mean that you have to go through a bunch of slippage and swapping fees. So we optimally show the scenario that would generate high APY for you.
Got it. Very cool. Okay, so you guys are a lab. So this is the first product that you guys have created. Let's talk about like this process of like why did you guys decide to do a lab? How do you find teams, and like what's your incubation process behind sort of building the next set of products?
Mm-hmm. Yeah, so I think it's very important for us to point out that we have multiple products in the pipeline, and we think that the best way to pretty much stay relevant in DeFi at all times, from now when DeFi is super young and nascent to in the future when DeFi is going to be more of the mass adoption and institutional friendly, then we have to build the products that are suitable to the market, right? Which means that we gotta always keep our eyes to find the product market fit. And definitely we don't want to pinch and hold to one particular product and just one single product, right? So hence we structured our project as a DeFi lab, making sure that we have the innovation ongoing to incubate and also build products. And building and incubating here goes internally and externally as well. So we built a number of products internally by the Alpha core development team, and we also help incubate other DeFi projects, pretty much less on the developing side, but more on mentorship, giving advice.
Right.
And pretty much that's through the incubator program, Alpha Launchpad.
And if you were going to sort of like say it was modeled on a particular style of incubation, is there any particular incubator program that you guys have borrowed inspiration from? Did you say it's closer to, I don't know, 500 startups or Y Combinator or Bootcamp, or like what's the style of incubation you guys have built, and why do you think this particular style of incubation is best suited for DeFi?
Mm-hmm. Yeah, so the end goal of Alpha Launchpad itself, which is the incubator arm of Alpha Finance Lab. So while we continue to build internally more Alpha products, right? Let's say like Alpha Homora, AlphaX, we also mentor and advise on other incubator projects through the Alpha Launchpad. So the Alpha Launchpad itself, we're pretty much taking the model and applying from Y Combinator. And I think it's pretty much needed in DeFi a lot, because if you look at DeFi in general, right, there are single projects, working as a standalone projects. And then there are a few Launchpad, which focus more on giving a place for these projects to launch their tokens. But there is no, projects or no teams that actually help early stage DeFi or even late stage, right? But the ones that are about to launch, to make sure that they launch and grow successfully, because I would say operating in the DeFi space is pretty difficult, and there are so many moving pieces. So definitely, giving a hand to newer teams, making sure that they have all the tools and support they need to launch and grow successfully, will help them a lot. It will also help DeFi a lot, and will bring value accrual back to Alpha as well, because once they work with us, we also have a condition that they give a portion of their tokens to our Alpha stakers. So by simply staking your alpha tokens, you're getting a number of things, including this tokens from the incubated projects.
Okay, and as an so speaking to DeFi teams that may be interested in being incubated by the Alpha Incubator. Sorry, is that the right name? Alpha Incubator? No, you called it something else.
Alpha Launchpad.
Alpha Launchpad. That's right. Alpha Launchpad. Is it so if it's modeled on Y Combinator, a 3-month program?
That's the end goal, but at the moment, not yet. At the moment, we're keeping it pretty flexible. There are a lot of late stage projects that apply as well, so they're looking for more less on the hands-on development side.
Okay, all right. So early stage projects for the Launchpad. What do you guys offer? Like what if you were pitching a project, a new project, what would you say, like, why they should consider applying to Alpha Labs?
So there are 2 to 3 main things that they pretty much get from launching and working with Alpha Launchpad, right? Which they will not be able to get anywhere else in DeFi. Pretty much, the first thing is we are a builder ourselves, so we pretty much know what are the things they need to launch and grow successfully, whether that means on the product side of things, technical side of things, or the business side of things, right? So really depending on what you need, we'll provide that support. So I think, that's very good that we have the builder experience. The second thing is, this also ties back to the importance of giving a portion of the token to alpha stakers, because this is pretty much the opportunity for the early and the new DeFi project teams to tap into such a large and heavy DeFi users. So if you look into alpha staking generally, right now there are 35% of alpha circulating supply being staked. So these are the heavy users in DeFi. Some of these are, large VC funds who are very active in DeFi. So this is your moment to actually, get in their radar and also convert them and work with them, right, to become your users, to become your investors. So I think this is more of a strategic way of distributing your token to the right audience, especially if you care a lot about growing your product. So that's the second thing. And I think the third thing is also being a part of Alpha Universe, right? So Alpha Universe here includes all the Alpha products, all the incubated projects. So which means that even once you are launched and you grow successfully, you would be considered, a part of the family pretty much. So if you want to partner with any of these products, any of the other incubator projects, will facilitate all of those community. So it would be like a mini community within DeFi itself.
Very cool. So what's the next thing you guys have got coming out?
Yeah, it would have to be the AlphaX, which is the second alpha product that we've been working on.
And is this an incubated team, or is this something you guys have built directly?
This is what we built internally. Yeah.
Okay. So AlphaX, and what's AlphaX?
Yeah, AlphaX, super hard to explain because it's a new concept again, right? Like it's
okay.
It's as if you were to ask me what Alpha Homora is before we introduced the concept of leverage yield farming. But it's the same mindset. We are always trying to find that product market fit, right? But on a high level, this product market fit is in the derivatives space. So very different space from Alpha Homora, which is in lending and yield farming. So this is a new area that we create in derivatives. So, it's a leverage derivatives, but it's not perpetual swap. It's not synthetic tokens. It's not options. It's not leverage tokens. It's a new category that we created ourselves. So yeah, excited
what's the problem that it's solving?
Mm-hmm. The problem pretty much is if you look into DeFi trading landscape right now, right? A majority of it is spot trading. Very, very little in derivatives trading. But if you look into even centralized exchange or even in traditional finance, derivatives trading is a lot higher in terms of volume, in terms of usages. So there's something missing there, right? That means there's no, like a lot of teams are still experimenting how they can crack and actually grow derivative space in DeFi. and pretty much.
But isn't the majority of derivatives trading CFDs, contracts for difference, FX, so foreign exchange, and interest rate swaps? Right, that's the majority of it. Like most of it isn't. Like the minority is like asset coverage, so like options on stocks, like apart from CFDs, right? But like hedging a position is sort of like the much smaller percentage of derivatives trading. The much bigger is things like FX and CFDs and interest rate. I mean, interest rates are like the biggest part of derivatives. But so like, which part of derivatives do you guys looking at?
Mm-hmm. So that's a good point, and I think that's totally valid if you're looking from traditional finance, right? But if you look into centralized exchange and you look at their spot trading volume versus derivatives trading volume, it's a huge gap. So that huge gap is what we're targeting, mainly more on asset coverage derivatives. But at the end of the day, how we do it is it doesn't matter what token it is. As long as we have a price feed for that, then we can have it supported on the AlphaX product. So it doesn't mean that it has to only be, the crypto assets that we trade derivatives on.
Got it. So like sort of you could consider it to be competing with like synthetics or I've completely forgotten the name, DYDX or something like that, or is a different product? Like who would be the user from a purchasing the derivatives point of view? What would they be purchasing the derivatives for?
Mm-hmm. Yeah, so this is more on deeper into the details. And pretty much I'm gonna save all
the details.
I'm gonna save all the sweet sauce for later, as we haven't announced much on what the AlphaX is gonna look like. But I'm gonna share. I can share a bit more, right? That it's definitely not. I mean, if you categorize DYDX synthetics into derivative space, which they are, then yeah, AlphaX will be in that area too. But the user group are not overlapping. And we're pretty much aiming
I'm still here. Don't worry. I'm not sure what happened there.
Okay.
I'm just going to switch you carry on. Sorry.
Yeah, and AlphaX itself is targeting a lot more on general DeFi users, so less on particularly the traders themselves.
Right. Okay. So DeFi users rather than the traders themselves. Okay. All right. And in terms of the Alpha Labs products, have you guys got what have you guys got coming up that you guys have incubated, or the Alpha Launchpad? Is there anything you can talk about there?
Yeah. So the first incubator project just announced last week. So they're called Beta Finance. Beta actually comes from the volatility, index itself in finance, right? So their product is to help offset volatility through a one-click short selling. So hence, that's a bit of background of their project and also their name. So they are looking to launch the product, in about Q3 timeline.
One-click short selling. That's really cool. And the Beta Finance, when's this expected to launch, or has it already launched?
The project has announced the product will be launched about Q3.
Okay, awesome. That's really awesome. Cool. Okay. And sort of to wrap up, like, what would be the starting point you would encourage most people to get started with Alpha? Would it be to buy the Alpha token itself, or would it be to go and use one of the products? Like, where do most of the users sort of get started? And it sounds like your community is a really important aspect of that. So where's the best place to sort of hang out and be part of the ongoing journey of Alpha?
Yeah, so I would say the best place to learn more would be the website. It has everything in there, from the project document to outline of all the products, right, and also the Alpha Launchpad. So I think that would be a good start. Second, on the community side of things, we're active on Twitter, active on Telegram, Discord. So any of those channels that work for anyone, well, feel free to join. These are also the links that are on the website as well.
Okay, awesome. It's been such a pleasure talking with you, Tascha. Thank you so much for coming on the show. If there is anything that you would like to say in closing, please feel free to do that now.
Yeah, I think it's just nothing much on my side, but more on, just very glad to be here and hope everyone stays safe, right? It's a weird time that we're going through right now.
It is a weird time. Thank you.
Thank you.